Hello everyone. So we are continuing with the accounting cycle. Hopefully you remember from the end of the last chapter, we ended up with an adjusted trial balance. And if you recall, I talked about every account here listed in red was adjusted. And so I made a point at the end of the last lecture that the adjustment process is very, very important. It affects a lot of accounts. So here's our adjusted trial balance, and the next steps in the accounting cycle is to take this adjusted trial balance and prepare the financial statements. And that is what we're going to do here. We are going to prepare the financial statements. The first financial statement that we're going to prepare is the income statement. The income statement has to be done first because it determines what net income is, and that is needed for the next statement, which is called the retained earnings statement, and that is prepared second. And then lastly, we're going to prepare the balance sheet. So the income statement, just a few things to point out here. The income statement is for a period of time. It's got a begin date and an end date. So whenever you prepare financial statements, just so we get an idea of how this looks, it starts out with 3 rows. The first row is the name of the company, and in this case we're dealing with Overnight Auto Service. The next line is for the name of the financial statement. In this example, it's the income statement, and the income statement has a begin date and an end date. It's for the year ended, or I should say from January 1 to December 31, 2018. And the income statement is simply the calculation of net income. And net income is basically your revenues less your expenses. Remember, revenues are the amounts earned from providing a service or selling goods to a customer, and the expenses are the costs of earning that revenue. And so our revenue amounts, we have 2 of them, repair service, and we also had rent revenue, $175,000 total. And the expenses, if we add them all up, they total $108,430. Subtract that from revenue, you get a subtotal called income before income taxes. Subtract out your income tax expense. You are left with net income. Now remember this number, net income, $39,942. That is the first financial statement, the income statement. Simply a summary of the revenues less the expenses, the calculation of net income. Now, the next statement is to prepare is basically the retained earnings statement. A retained earnings statement is a roll forward of the retained earnings account from the beginning of the year to the end of the year. If you recall, the retained earnings is that one account. It's one of the accounts in the equity section on the balance sheet. Remember the balance sheet. Assets equals liabilities plus equity. Well, that retained earnings account is one of those accounts in the equity section. I also told you in an earlier chapter that the retained earnings account is really the summary of the red accounts. R-E-D. Revenues increases the retained earnings, and the E and the D, the expenses and the dividends, decrease the retained earnings. So this is a brand new company, so retained earnings at the beginning of the period, which in this case happens to be January 20th. That was the first day that this company was organized. It was 0. Now remember, retained earnings is going to go up with the R, the revenue, down with the expenses and the dividends. So we're going to say add net income. And do you remember this number, $39,942? You should remember this number because that was the result of the income statement. And what is net income? This is basically the revenues minus the expenses. It's the R minus the E. And there's your subtotal, and here's your D, dividends, less the D, the dividends. So the retained earnings at the end of the year is $25,942. Remember this number because we need it for the next financial statement, and that is the balance sheet. The balance sheet, unlike the other 2 financial statements, The other two financial statements were for a period of time. It had a begin date and an end date. But the balance sheet does not have a begin date and an end date. If you take a look at it, what does it say? It says December 31, 2018. It doesn't say for the year ended. It just says December 31, 2018. The balance sheet is the snapshot statement. It's the photograph statement. You all take photos because you want to capture a moment in time and look back at those photos, years later. But it captured a moment in time. That's what a balance sheet does. It's the snapshot financial statement. So as of this moment in time, close of business, December 31, this is what all of our assets look like. Cash, accounts receivable, shop supplies, your unexpired or your prepaid insurance, your tools and equipment, less its contra, and there's the net book value, $9,800. The building, less its contra, and there's the net book value, $34,350. Land, $52, and you add up all of your assets, total assets, $126,192. That's on one side of the balance sheet. The other side of the balance sheet, we have our liabilities and our equity. Our liabilities, notes payable, accounts payable, wages payable, income taxes payable, interest payable, and your unearned rent revenue, aka customer deposit. We talked about these liabilities, at least the adjustments to these liabilities, in the prior chapter. Total liabilities is $20,250, and our equity is broken down between the capital stock and the retained earnings account. Hopefully you recall that this retained earnings balance, we got that from the prior financial statement, the statement of retained earnings. So you can see all of these financial statements are connected. The net income is connected to the retained earnings statement. The retained earnings statement is connected to the balance sheet. And there is a fourth financial statement called the cash flow statement, which basically details out the cash, how we got the cash from the beginning number to this ending number. But that is for another day. We'll actually take a look at that in the last chapter of the semester. And then our total liabilities and equity down here, $126,192 equals the total assets. So very important to prepare our financial statements in this proper order. Income statement first, retained earnings statement second, balance sheet third. Okay, balance sheet gets classified. I should say that. Basically, what we're going to do is we're going to take our assets and break them up into two subsections. We have current assets and non-current assets. Basically, the current assets include anything that's cash or basically converted to cash or used up within a year. And non-current assets would be anything that is not going to get used up in a year. So that's typically the property, the plant, the equipment, the land, buildings, etc. And then your liabilities. We have current liabilities and long-term liabilities. Current liabilities are basically debt that's going to be paid within a year, or unearned revenue that would be recognized as revenue within the year. All right, so just wanted to show you the classifications. We can break up the balance sheet into subsections. Now, along with the financial statements called footnotes, there are footnotes to the financial statements, and basically what these footnotes do is they basically describe the numbers or the accounting policies that are behind preparing all of those numbers in the financial statements. So the footnotes is a very important part of preparing the financial statements as well. Okay, now after we are done preparing the financial statements, the last couple of steps in the accounting cycle is to close the books. And what accounts are we going to close? And what does this term close mean? What we're going to do is we're going to close the temporary accounts, aka nominal accounts. We're going to close the temporary accounts to zero. And what are the temporary accounts? The temporary accounts are the red accounts. The revenues, the expenses, and the dividends. And basically what this closing process is all about is closing the red accounts out to retain earnings. We make the red account balances 0. All of those account balances are transferred into the retained earnings account, and the red accounts will start the next period with fresh zeros. So we're going to capture revenues, expenses, and dividends for the year. Once we close them or zero them out and transfer their balances into the retained earnings account, we start the next period with 0 revenue, 0 expenses, and 0 dividends. The permanent accounts are the balance sheet accounts. So all of our assets, our liabilities, and our equity accounts, they are the permanent accounts. They never go through a closing process, if you will. We don't close them to 0 and start fresh with zeros. Only the red accounts. And that's what the closing process is all about. We're going to use this account called income summary during the closing process. Here are the 4 steps in the closing entries. We're going to close all the revenue accounts to this temporary account called income summary. And then we're going to close all the expense accounts to this new account called income summary. And then we're going to close the income summary account to retain earnings. And then we're going to close the dividends account directly to retain earnings. Now, don't let this word closing fool you or confuse you. The word closing simply means we're going to make the account balance 0. All right, so here's the example. First, close the revenue accounts to 0. So if we go back to the income statement, you're going to see that there are 2 revenue accounts. The one revenue account was called repair service revenue, and that had a balance of $172,000. And then there was another revenue account called rent revenue of $3,000. Now, revenue accounts have a credit balance, which you should know off the tip of your tongue by this point in the course. Revenue accounts have a credit balance. So how do I make them 0? Well, to make a credit balance 0, what we would need to do is we would need to debit those account balances. So we're going to debit revenue, the revenue accounts, and then we're going to credit this account called income summary. So at this point, all of our 2 revenue accounts have a 0 balance. That's good. So we're ready to start the next period with fresh zeros. All right, and here's a visual. You can see the revenue account had a credit balance, and we just debited it during the closing process. The rent revenue account had a credit balance. We just debited it during the closing process. And now we have this $175,000 credit in the income summary account. Now the expense accounts. Expense accounts have debit balances. So to close the debit balances, we will credit all of the expense accounts. And so that's good. We're closing all the expenses with credits. And the debit is going to go once again to this account called income summary. So if we take a look at the visual, you can see all the expense accounts which had debit balances. We just credited all of them and we debited income summary. So at this point, you're saying to yourself, okay, all the revenue accounts have 0 balance. That's good. All the expense accounts have 0 balances. That's good. But now all of a sudden, we have this credit balance and income summary of $39,942. Because remember, we credited it for $175 to close out the revenue accounts. We debited it $135,058 to close out the expense accounts. So now we have this running balance of a credit, $39,942. Now we got to get rid of that. And how do we get rid of that credit balance? Well, we debit it. And the credit goes to retain earnings, $39,942. Does anybody remember this number, $39,942? And hopefully your answer is yes, I remember that number, Professor. That is net income. Test me. Go back a few slides. Take a look at the income statement. You will find that the net income is $39,942. Right? Go back to the retained earnings statement. Do you remember we increased retained earnings by $39,942? Boom, there it is. $39,942, the increase to the retained earnings. This is the R minus the E. This is the revenues minus the expenses. All right? And so once again, the retained earnings, if you remember the retained earnings statement, we started with 0, and then we increased it $39,942. And the last closing entry is to close out dividends. Dividends have a debit balance, so I will close them with a credit, and the debit goes to retained earnings. That is the D in the RED. All right, so retained earnings, once again, we started with 0. We added for the R minus the E, and then we subtracted for the D, the dividends. And there's your running balance. And the next question is, do you remember this number, the $25,942? Hopefully you do, because that was the amount on the balance sheet. It's all connected. If you understand this process, this is great. This is the accounting cycle. If you've understood what I've done up to this point, you are in great shape. And basically what we've done up to this point is we've gone through the bookkeeping process. So I can tell you at this point, you are now qualified to be a bookkeeper. But we're going to go way beyond just being bookkeepers. From this point on in the course, we're going to learn more about the difference between bookkeeping and accounting, and to show you what a CPA does. And of course, it'll be continued into future accounting classes. So here's the flow chart. You can see the visual. First, the revenue accounts are closed out into income summary. That's step 1. Step 2 of the expense accounts are closed out into income summary. And then this running balance and income summary is closed out into the retained earnings account, and your dividends is closed out into retained earnings. So at the end of the day, the R, the E, and the D accounts all have 0 balances. It all got summarized into retained earnings. All right? And when we are done, the last item you're going to see is an after closing or a post-closing trial balance. Now, if you compare this after closing trial balance to the adjusted trial balance, which was the first slide that we started with in this particular presentation, what you're going to see the difference is, you're going to see the after closing trial balance, everything has been conglomerated, or the RED accounts have been consolidated, that's a better word, into the retained earnings account. The adjusted trial balance that we started this chapter with had retained earnings balance of 0, but it had the breakout of the revenue, the expense, and the dividend accounts. The after closing, all those balances are now 0, and they're all consolidated into this one number.